Hey there, welcome back to my channel, it's me the Mind Injector. Today, we're diving into the fascinating and tumultuous world of NIO. There's been a lot of buzz around NIO lately, especially with the advent of autonomous driving technology and the recent fluctuations in its stock price. But is all this excitement justified, and what does the future hold for NIO? Let's dig deep into this topic, analyze the facts, and see if NIO is worth your investment. A future with driverless cars is quickly approaching, and it seems like China might be at the forefront of this revolution. Recently, the country approved multiple Chinese automakers to pilot vehicles with Level 3 or Level 4 autonomous driving capabilities. Among these companies is NIO, a significant player in the electric vehicle market. Despite this potentially game-changing news, NIO stock hasn't seen much of a boost. This raises the question, why? There's almost no doubt that the next phase of transportation will be autonomous driving. Tesla has been working tirelessly to perfect this technology, although not without facing significant setbacks. Now, China is paving the way for its domestic automakers to start testing autonomous vehicles on public roads. This move is part of China's strategy to accelerate the adoption of self-driving cars and improve the integration of intelligent connected vehicle systems with road infrastructure. Currently, NIO stock is down, despite showing positive trends over the past week. This decline is perplexing, especially when we consider the impressive delivery numbers NIO reported for May 2024, showcasing substantial year-over-year growth. However, while NIO is making strides, it still faces significant challenges and skepticism from the market. NIO is not alone in the race towards a driverless future. Other strong competitors, like BYD, are also on China's driverless vehicle list and are currently performing better in the stock market. BYD has reported robust delivery growth for May 2024, which has positively impacted its stock price. In contrast, despite NIO's impressive delivery numbers, its stock remains in the red. For all the challenges NIO has faced over the past year, it has managed to stay competitive. NIO has outperformed several risky EV stocks like Mullen Automotive and Fisker. However, despite strong deliveries and securing an external investment for its power unit, NIO stock struggles to stay above the $5 mark. NIO reported delivering 20,544 vehicles in May, up by an astounding 233.8% year-over-year, reaching a monthly record high. This is the second time NIO has delivered over 20,000 vehicles in a month, the first being in July 2023. These numbers brought NIO's year-to-date deliveries to 66,217, marking a 51% increase year-over-year. Before the May delivery numbers were released, Bank of America analyst Ming-Sun Lee predicted strong second quarter deliveries for NIO, thanks to the release of its 2024 models and a significant reduction in the monthly leasing price for its battery-as-a-service by as much as 33%. Based on these factors, Lee raised his 2024 delivery outlook by 6% to 193,000 vehicles, implying a growth of 20.6% compared to 160,308 deliveries last year. However, Lee also lowered his NIO stock price target to $5.90 from $6.50, citing higher expected operational expenses. Lee now expects NIO to spend more on operational expenses than previously anticipated, with an OPEX to revenue ratio estimate of 41.6%, up from the previous estimate of 34.8%. This increase is mainly due to anticipated higher sales and marketing expenses amid the launch of NIO's new NIO vehicle brand and expected 2024 research and development expenses of $1.89 billion. The NIO brand unveiled its first vehicle, the L60, last month at a starting price tag of $30,500. For the first quarter of 2024, analysts expect NIO to report revenue of $1.443 billion, signaling a yearly decline of 2.1%. NIO is also expected to remain unprofitable, with a GAAP EPS loss of 28 cents compared to a loss of 41 cents a year ago. These financial metrics highlight the significant challenges NIO faces in its quest for profitability. China's push for EV adoption is a positive driver for NIO. Despite a general slowdown in EV demand, NIO operates in a market where demand is holding up better than in the United States. NIO's strong relationship with the Chinese government provides an additional advantage. Also, the company's robust product portfolio positions it well in the market. NIO's battery swap technology, part of its battery-as-a-service strategy, sets it apart from competitors. The company has installed 2,419 power swap stations worldwide and aims to build 1,000 more in 2024. Expanding partnerships with major Chinese automotive groups is bolstering this ecosystem. NIO's financial position improved following a $2.2 billion investment from Abu Dhabi's CYVN Holdings in December. This investment strengthened NIO's balance sheet, enabling intensified brand positioning, enhanced sales and service capabilities, and significant investments in core technologies. The recent launch of the low-cost Anvo model, the L60, priced around $34,600, could boost sales, though the impact on manufacturing costs remain to be seen. Additionally, NIO's acquisition of 2 GAC plants is expected to reduce production costs, enhancing efficiency and competitiveness. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. Despite these positive developments, NIO is still not turning a profit and continues to need ongoing capital injections, which brings the risk of stock dilution. This means that even if the stocks start to recover, new share issuances could quickly offset those gains. Furthermore, the intense competition in China's EV market with numerous companies and models entering the market is forcing players to slash prices. NIO will have to put more effort into gaining buyers' attention, and slashing prices could squeeze margins further. One crucial aspect that investors are already aware of is the delivery numbers. The company delivered 30,053 vehicles in the first quarter of 2024, a 3.2% decrease year-over-year, which is expected to impact revenues. Another key metric to watch is vehicle margin. In the last reported quarter, the metric came in at 11.9%, improving 90 bps sequentially and 510 bps yearly. With management's optimistic guidance of a 15 to 18% margin for the year, investors will be watching for signs of sustained improvement. That being said, the company needs to further reduce its manufacturing costs as well as operational expenses, as it is incurring substantial losses from operations. In the fourth quarter of 2024, operating losses surged 37% year-over-year, albeit declining 1.6% sequentially. Maintaining a steady improvement in operating margin is crucial for NIO's path to profitability. So, where does this leave us with NIO? The company is making significant strides in autonomous driving and EV technology, supported by a strong relationship with the Chinese government and a robust product portfolio. However, the road to profitability is fraught with challenges, including high operational expenses, intense competition, and the need for continuous capital injections. For investors, NIO presents a complex picture. On one hand, the company's innovative approach and market positioning offer substantial growth potential. On the other hand, the financial challenges and market skepticism cannot be ignored. It's crucial to keep a close eye on NIO's quarterly results, particularly its delivery numbers, vehicle margins, and operational expenses, to gauge its progress towards profitability. As always, investing in high-risk stocks like NIO requires careful consideration and a well-thought-out strategy. If you're considering investing in NIO, make sure to weigh the potential rewards against the inherent risks and keep an eye on the broader trends in the EV market. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.